Welcome to this explainer. I'm absolutely thrilled you're here today because we're about to unpack one of the most bizarre and honestly fascinating economic paradoxes playing out in Europe right now. We are looking squarely at Germany's property developers, known as the Bauträger. Now, if you follow European real estate at all, you know the German market has been on a wild roller coaster lately. But right now, we're seeing a stark tale of two completely different realities crashing into each other. On one hand, you have massive, ambitious expansions. On the other, a crushing insolvency crisis. It is a literal construction paradox. And look, if this can happen in Europe's economic engine, it can for sure happen anywhere. So let's dive right in and break down exactly what's going on.
Here is our roadmap for today. We're going to start with the core German housing paradox, then look at developers expanding despite the crisis, and track the global moves and big money. After that, we have to face the insolvencies and the dark side before wrapping up with the path forward.
All right, let's jump straight into Section 1, the German housing paradox. We're looking at surging permits versus plummeting completions.
We really have to ground ourselves in this overarching mystery. Germany is Europe's largest economy, right? And the country's in desperate need of hundreds of thousands of new homes. The demand is absolutely there. People need places to live. Yet somehow the nation is just failing to get shovels in the ground. Construction completions are plummeting. So why is an economy with such ferocious demand fundamentally failing to build the actual homes its population needs?
Well, the cognitive dissonance in the market right now is just staggering. Building permits actually increased by 24.1% year over year as of February 2026, and for new builds specifically, they jumped over 30%. I mean, developers are drawing up plans, the government is approving them, but actual housing completions are dropping like a stone. We literally have a mountain of approved blueprints, but very, very few newly built homes.
So, what's actually stopping these approved projects from becoming physical buildings? A PwC study from April 2026 gives us a pretty clear answer. 91% of the companies they surveyed cite rising cost pressure as their #1 concern. The math simply isn't mathing anymore. You've got sky-high construction costs paired with an incredibly expensive loan environment. Add to that the really strict building regulations and highly uncertain subsidy conditions, and developers are essentially being forced to halt or indefinitely postpone projects they already have permission to build. Suddenly, those blueprints are just way too expensive to execute.
Which brings us to Section 2, expanding despite the crisis. Let's look at some major acquisitions by the Instone Group.
Okay, so despite the overall doom and gloom we just talked about, a recent study by Simon-Kucher found that some major companies expect average revenue growth of more than 7% in 2026. Take Instone Group, for example, one of Germany's leading residential developers. Instead of shrinking back, they are aggressively expanding. In Rottenburg am Neckar, their subsidiary acquired land for 54 barrier-free residential units, and construction is slated for early 2027. Then, on a much grander scale, they acquired a massive 25,000 square meter former hospital site in Berlin-Charlottenburg. They're planning 640 apartments there to be built between 2028 and 2033. They are making huge, bold bets while a lot of their competitors are just frozen.
And it's not just about building luxury units for the wealthy either. Looking closer at that Rottenburg project, Stefan Dahlmans, the managing director of Instone's subsidiary nyoo, emphasizes this perfectly. He points out that their aim is affordable housing without sacrificing quality or sustainability, and they're really backing that up. 15% of that Rottenburg project will be publicly subsidized, and it's going to meet strict Efficiency House 40 standards with QNG certification. That means photovoltaics, green roofs, local heating networks, the whole shebang. They're actually finding ways to make sustainable, affordable builds pencil out.
As for that massive Berlin project, Seda Bogens, a branch manager at Instone, captures exactly why this acquisition is such a strategic masterstroke. She notes the rarity of developing hundreds of apartments based on existing planning permission. In a market that's tangled up in red tape and delays, acquiring a site that already has its planning permission sorted is a colossal competitive advantage. It basically allows them to completely bypass the bottlenecks that are choking the rest of the industry.
Let's move into Section 3. Global moves and big money, where we'll explore how developers are capitalizing on transatlantic and institutional wealth.
Bypassing domestic bottlenecks often means finding entirely new borders altogether. Take the Hamburg-based developer Garbe. They already have a massive $17 billion in assets under management in Europe. But rather than sit around waiting for the German market to unfreeze, they're making a big U.S. debut. They acquired a 50% stake in Boston-based Berkeley Investments, launching a joint platform called Berkeley Garbe LLC. They're taking their institutional investment track record and immediately deploying it into the U.S. industrial, logistics, and multifamily markets. It's a fascinating evolution from a German heavyweight into a true transatlantic powerhouse.
Meanwhile, back home in Germany, massive institutional money is finally starting to flow back into the residential market, which is a vital sign of returning confidence. German developer Pandion recently secured 100 million euros in financing from the global investment firm Värde Partners, secured against a 13-asset portfolio across major cities. At the exact same time, ABG Real Estate Group and Simon-Kucher launched a joint fund targeting 200 to 250 million euros in equity, specifically for urban project developments and converting disused office space. The smart, global money sees the bottom of the market and is making its move.
But we do need to make a sharp pivot here into Section 4. This is where we look at insolvencies and the dark side, the market's veritable crisis.
71. Between January and October of 2025, exactly 71 residential contractors entered insolvency. These aren't just paused projects, folks. These are companies going under entirely. It's a very stark reminder that this recovery is highly uneven and the casualties out there are very, very real.
And for the developers who haven't gone bankrupt, a lot of them are just stuck. In the latest quarter, 32% of all residential projects experienced delayed construction starts. Andreas Bulik from the Developers Association, BFW, doesn't mince words. He calls this a veritable crisis. A third of the entire residential market is effectively frozen in place, just waiting for conditions to improve. The fundamental math behind these frozen projects has just completely broken down. Because of higher interest rates, capital service costs are way up. As a result, equity requirements for residential developers have jumped to around 25%, and for some hotel projects, it's as high as 50%. The gap between what it actually costs to build a project and the revenue it will eventually generate has widened dramatically. Developers are being asked to cover that gap with cash they simply do not have. Holger Kubal over at DKB Bank sums this disconnect up perfectly. He says, "We have no problem providing debt. The problem is equity availability. The lenders are sitting there with the money, totally willing to finance viable projects. But because the costs are so high, developers just cannot come up with a massive 25% equity required to unlock that debt. It's a really frustrating stalemate."
So how does this all resolve? Let's move to our final section, the path forward, looking at implementation bottlenecks and future forecasts.
First, we have to face the immediate consequences of all these halted projects. Housing completions were already struggling at around 180,000 in 2025. But looking ahead to 2026, the IFO Institute forecasts just 185,000 completions, which would be a 15-year low. And other, slightly more pessimistic industry forecasts? They predict completions falling all the way down to 150,000. That is a drastic shortfall against the hundreds of thousands of homes Germany actually needs. The immediate future is going to be incredibly tight for housing supply.
And the crucial point here is captured beautifully by Dr. Marcus Mayer. The issue is not that people don't want to buy or rent homes. The demand is ferocious. As he says, the bottleneck is shifting from demand to implementation. The entire system, from skilled labor shortages to bureaucratic red tape to those massive equity requirements we just talked about, is jammed at the implementation phase. The desire to build is absolutely there. The capacity to actually execute is what's broken.
But there is some light on the horizon, specifically when you look toward 2027. Political measures are starting to form, like the Bauträger Turbo, which is a construction turbo initiative meant to strip away a lot of that red tape. Infrastructure special funds are also promising to inject some serious momentum. However, most companies don't expect to really feel these effects until 2027. So to survive until then and to thrive when the floodgates finally open, developers have to relentlessly focus their internal operations on capacity, efficiency, and sustainability right now.
Which leaves us with this final thought. The recovery of the German property market is coming, but it's going to be incredibly uneven. We are essentially watching a real-time stress test of Europe's largest economy. So, will the next few years effectively separate the resilient, forward-thinking developers from everyone else? The data certainly suggests that those who can adapt, secure smart financing, and streamline their implementation will absolutely conquer the market. Meanwhile, those just waiting for the old normal to return? They might just be left behind. Thank you so much for joining me for this explainer. I really hope this helped make sense of a complex situation. Keep learning, and I'll see you next time.